Hi everybody, I'm Rob Atherton, Head of International Wealth here at Melbourne Capital Group in Malaysia. We're an independent financial services company providing corporate and personal tailored solutions to help our clients achieve their financial goals. Today I'm proud to say we're joined by Daniel Chung, who is the CEO and CIO for Alger, a US-based, privately owned investment management company. Hi Daniel.
Hi.
Today I wanted to start by asking you a little about Alger's investment strategy.
Right.
Thank you.
So our strategy starts with our philosophy of investing in positive dynamic change. This is the strategy the firm was founded on over 60 years ago and has become famous as sort of an originator for growth style investing. The key principle of investing in positive dynamic change is that we're always looking for the most innovative, disruptive companies in every sector. Second principle is that we think about two categories of opportunity. One is high unit volume growth. So we're always looking for the fastest growing part of an industry and trying to identify what are the growth companies that are leading that are identifying the change and the innovation that is driving that high growth. So we look for that and try to find the best ones. But the other part of our philosophy is the flip side of that, and we call it positive life cycle change. So in this sense, these are companies actually that might have been struggling with growth, might have been facing challenges. But we recognize there that new management, new product introductions, restructuring and M&A can essentially create a growth renaissance for those companies. So our philosophy again is we look for both the high unit volume growth companies and also the growth renaissance potential companies. And those are where we focus on across industries.
Alger has spent over 6 decades now refining its strategy of investing in positive dynamic change. Could you kindly elaborate on that and tell us what it entails and the benefits of it, please?
Sure. So one of the things that we recognize about in our philosophy is that where the degree of change or disruption is the greatest in an industry is actually a great opportunity for fundamental analysis led by our deep expert analyst and PM team. We have 60 people in the investment team. Our average PM has 17 years with Alger, over 25 years in the industry, and we have equally experienced senior analysts and analysts driving that research. The core of the firm, therefore, is fundamental research. What the philosophy says is wherever you're seeing disruption, the patterns of an industry that created the winners of that past, let's say, decade, might be changing enough that the future winners in an industry might be totally different. So think retailing.
Okay.
You know, in the 90s, big boxes and department stores were the winners. But then Amazon and e-commerce happens.
Yes.
Understanding that e-commerce was growing rapidly and that even though in 1998, Amazon was the only e-commerce company and stock to invest in, that e-commerce itself as a secular trend was going to totally upend traditional brick and mortar retailing. Right. We all know that, of course, happened. But the tricky part and the best part of our philosophy is it directs us to look at these situations and understand that although Bloomingdale's and Macy's were the department store leaders, that this upstart Amazon with its new business model might actually disrupt them. And we were early investors in Amazon, in fact, investing in their IPO. We continue to be investors in Amazon today. It's one of our top holdings. And it's an example of sort of how we apply our philosophy using deep research, careful valuation analysis based on multiple scenarios, but ultimately understanding like we want to be positioned with the best secular growth trends.
Yeah, thank you. And Alger has launched a range of thematic and alternative investment strategies with a specific focus on bioscience and AI. So could you kindly tell us why these sectors and, for investors listening today, possible risks and the rewards in those sectors?
Sure.
Please?
So first of all, why these sectors? Well, technology, e-commerce, and healthcare actually represent some of our deepest analyst talent and our longest experience. These are sectors that we know extremely well, have been investing in for literally 60 years. AI, of course, is the hot topic of the moment, but it's more than the hot topic of a moment. It is a secular trend that will impact and transform every industry. It's going to touch every industry. Now, some industries probably won't change that much, but others are going to be transformed.
Right.
So that's the reason for a strategy that's directed at finding not only the best sort of AI enablers, so data centers, technology, but AI adopters, so identifying companies that are going to be benefiting the most from the adoption of AI in their business. So that's the reason for that strategy. Quite different is the Life Science Innovation Fund. Again, it reflects a deep history in healthcare that we have. Our healthcare team is actually led by, I call him a triple crown. Dr. Sanjeev Talwar is both a doctor, a PhD who did medical and clinical research as well as practiced, who then went to a major worldwide top 3 consulting firm and led their global healthcare consulting practice. That's the triple three. Before he became an investor and joined Alger. His strategy is almost the opposite of the AI strategy. It's focused on often pre-revenue, early stage biotech, pharma, and medtech companies. It is therefore based, this is a truly fundamental fund in that it's based on his insights about the scientific value of a company, the value of its products and platforms, and his deep understanding of not only the medical knowledge and the PhD type knowledge that he has, but also the industry and where are the biggest unmet needs, where are the biggest opportunities in pharma and biotech. So that's the reason for that fund. Now, both of these funds have obviously some risks with them. I'll start first with the healthcare biotech fund. I mean, this is a very volatile sector. And to highlight that, after 2 years in a row since founding, being up 30% and 30%, in the first half of this year, it was down probably about 30%. It has also since then come back about 60% as we speak today. So year to date, it is up. But I think that highlights the volatility. Look, the healthcare sector, and in particular biotech, there's a lot of what we call binary events. In other words, Sanjeev can read all the clinical data. He can look at competitors' clinical data. He can study the molecules himself and come to his own conclusions about the path of a potential drug. But what he can't do is actually predict whether the phase 3 clinical trial is going to work or not, to a degree that's commercially viable. And if you know biotech investing, that what they call binary event, either yes, it works or it doesn't, creates a lot of upside and downside in biotech stocks. So that is clearly the risk. I do think one advantage of this fund is it's a very difficult sector you can't index this, and it's very difficult to invest in otherwise. But I think it offers a couple things. One, very high growth, very high innovation in a non-economically sensitive sector, healthcare. And ultimately, I think it will be a very non-correlated asset class.
Okay, that's interesting.
The AI fund, this is obviously very tech-heavy, although one day we'll expect to see a lot of adopters in the portfolio. Adopters will not necessarily be tech companies. They can be healthcare, they can be consumer, they can be waste management, certainly industrials. But it is an AI fund, a lot of tech exposure. Obviously, that sector too can be volatile. And in particular, I know there's a lot of talk about is there an AI bubble? We think it's way too early. We think the AI trend will last for a better part of a decade. But that doesn't mean it's going to be a straight line. There's clearly going to be moments people have doubts and concerns. These stocks are also likely to be more volatile around those kinds of concerns.
Okay, thank you, Dan. That's brilliant. You've made a case for US equities, Dan, particularly growth stocks, remaining a core allocation for investors in Asia. So why do you believe that to be the case?
Well, it's interesting. I was recently studying for a very large client in the US, their use of the MSCI All Country Index. And this is for a US client. And what I noticed was that the US allocation within the MSCI index is really constructed as like an S&P/value index. And so this client had ended up being under-indexed to a lot of the biggest growth stocks. They had some Microsoft and they had some Amazon, but relative to the weightings that you would see, for example, in a growth or S&P, they were under-indexed. And I thought that was unusual and a mistake. Why do I think it's a mistake? Well, first of all, large cap US growth has outperformed all of the other main 9 categories, growth, value, core, large, mid, small. US large cap growth has been the absolute best performer and also handily outperforms the S&P 500 itself. Second, I think there's a fundamental reason for US large cap growth continuing long-term outperformance, which is it represents the US's best industries, the ones where we are leaders, tech, e-commerce, healthcare, and is underweighted sectors where there's a lot more global competition, or we're not clearly a leader. So it's underweighted things like energy, real estate, financials, mining, and materials.
Okay.
Right. So I think every investor really, and I think really especially non-U.S. investors, should think about, if you want to invest in the U.S., why not have the portfolio have a portion reflecting the best sectors within the U.S.?
Yeah.
Right. And these are the sectors, of course, that have produced the global leaders of Google, Tesla, Amazon, NVIDIA. And it's my belief that all of those companies are driven by secular trends across the world that will continue. They may be new names 10 years from now, and they won't necessarily be all US. But if you were going to invest in the US, your best chance of getting early overweight exposure to them is to focus on US large cap growth.
Yeah.
And so that's why I believe that would be a good way for any investor to think about their asset allocation, even when they're index oriented, to understand what's the nature of the indexes that they're investing in. And I think the US is a growth market, not a value market, if you will.
And Dan, in a recent article, you spoke about passive investing distorting market pricing.
Yeah.
And obviously you're a active investment house. How do you anticipate this trend evolving, and what opportunities does it present for an active fund manager like Alger, please?
Right. So in U.S. large cap, passive investing is now more than 50% of the stock ownership.
Okay.
This results, of course, in a no individualized stock picking, which means that part of the stock market, differential fundamental performance of actual companies, like in the real world, is not really reflected. It's not reflected until the index manager changes the weighting of the company, right?
Yeah, yeah.
I think we've seen very strong outperformance in the last couple of years since coming out of COVID, partially because radical change coming out of COVID, big geopolitical change, Trump administration, tariff, war, and then finally AI and other trends in the world. Not everything is happening in the U.S. China has major changes.
Sure.
This region has major changes tied to China, and some not.
Yep.
And Europe, of course, is dealing with outcome of Ukraine-Russia war, tariff war, all kinds of things. I think it's why, for example, we've handily been outperforming the indexes, because when there's a high degree of change, it offers the most opportunity for active investors to take advantage of that.
Yes.
Whereas a passive index, of course, is non-changing and not reacting to that.
Yeah.
So there's clearly a place in, I think, portfolios for both styles of investing.
Yep.
And that's what I would recommend to most investors: have some active managers and have some passive indexes, and maybe the balance between the two you shift depending on where you think the opportunity is.
Okay.
But I think passive investing has changed active investing, and in some ways is offering better opportunities because of kind of the change of volatility that we're seeing today.
Okay, thank you very much. And Dan, Alger has recently decided to make a move into Asia. Can I ask you why now? And I guess following on from that, the long-term vision for Alger in Asia?
Yeah, so we've long had interest in Asia, but you're right, we've upped our investment in the area. In particular, we have a Singapore-based office led by Stephen King. Yeah. And we are excited about the opportunities here for multiple reasons. One is, obviously, this is a growth region in the world. Secondly, we spend a lot of time here actually doing research in the past. It seems worthwhile for us to also try to actually have business here with clients here. Yeah. I always learn so much actually visiting the region from yourself, your team, and clients, just asking them about what they think is happening. So there is actually a feedback that's positive for our investment process by learning a bit there. But it's the right time for us to try to expand internationally. I mean, we're a U.S. domestic boutique. Our client base is 96% U.S.
Okay.
At $32 billion, of course, we have the resources now to really try and go more global with our client base, and so that's why we're trying.
Thank you. How does Alger's offering seek to meet the needs of Asian investors?
Well, I mean, I think first and foremost, we have a complete lineup from small, mid, large cap U.S. strategies. We also have some of these specialty thematics, AI, life science innovation, and we also do long, short, and more conservative investing styles that for clients who are more sort of capital preservation oriented. So we have the full range of capabilities for many clients. But I think one advantage we have is we're a boutique, and we are looking for partners in every region. And we have a long history in the US of doing custom portfolios with custom guidelines for our clients there, institutional clients. And we're excited to explore that opportunity here in Asia. And as I've been traveling in Asia, we've had many discussions with potential partners about what kind of strategies, US strategies that we do might fit their clients' needs.
We know that trust is a cornerstone of our profession. So how do you intend to go out positioning Alger as a trusted partner in Asia?
Well, the challenge for us as a boutique is we don't have the big brand name. We're much smaller than some of the big household names here. I think we really just have to rely on two things. One is the opportunity, which I thank you for today, of telling our story. We're 60 years, private firm, pursuing a singular focus on growth equity. So hopefully that resonates with some clients. And really the second is partners like yourself. Do the due diligence on Alger, understand the broader landscape of potential investment management firms, and hopefully can see that firms not just like Alger but other boutiques that we offer a lot of value, maybe even as just diversification to sort of the mainstream firms. So I have to be humble about it because we're a small firm. We have a very small part of our clients are international, and I'm just hoping that we can find the right partners and clients here in Malaysia and of course broader Asia.
Thank you, Dan. I'm sure you're going to be really successful, and we're very much looking forward to working with you going forward. Thank you very much.
Thank you very much.
Thank you.